Most people enter trading trying to predict the market. Professional traders survive by understanding behaviors, probability, and the risk. Prediction is actually the smallest part of the game. So, before charts, indicators, or strategies, this channel is about learning how the market really moves and how traders actually lose the money. To access the market, you have to open an account with a broker. As a retail trader, you do not have an access directly to the stock market. Once you open an account, then you can start buying and selling and you can start the trading. How broker makes the money? Broker makes the money with a spread. And what is spread? What is bid? What is ask? Bid is the highest price a buyer is willing to pay for anything. This is the price you receive when you sell. And the ask price, the lowest price a seller is willing to accept. This is the price you pay when you buy. And the spread is the difference between the bid and ask price. And this is the broker's fee built into every trade. A tighter spread means lower cost for you. When we start trading, we have to understand few things before we open a position or before we buy or sell. For example, PIP. What is a PIP? PIP is a percentage in point, is the smallest standard price movement in Forex. For most pairs, it's the fourth decimal place. As you can see, 0.0001, the last fourth one is the PIP. For example, JPY exceptions. For Japanese yen pairs, a PIP is the second decimal place, 0.01. So after the point 0.01 is the PIP. So USD JPY moving from 150 to 150.01. So the last decimal 1 is a PIP. PIP value, actually the monetary value of 1 PIP depends on your lot size. For a standard lot, 100,000 units on Euro USD, 1 PIP is equal to $10, mini lot $1, and micro lot $0.1. If we take example of Euro USD, move from 1.1050 to 1.1080, that is equal to 30 pips gain. On a mini lot, that's the $30 profit. After the pip, lot and position sizing. So now the question is, what is a lot? A lot is the standard unit of measurement for a trade. It determines how much currency you are buying or selling. Standard lot, 100,000 unit of the base currency. 1 pip is equal to $10, used by experienced trader with larger accounts. Mini lot, 10,000 units. 1 pip is equal to $1, a good middle ground for intermediate traders. Then next is micro lot. Micro lot, 1000 units is equal to 1 pip and 1 pip is equal to 0.10. Ideal for the beginners. Allow you to trade real money with minimal risk while learning. Of course, as a new trader, you cannot directly open the standard lot. As soon as you open the standard lot and you don't know, you are just guessing like market will go that direction, and you open the standard lot, the time in the next few seconds you won't see your account active. So as a new trader or as a beginner or intermediate trader, so micro or mini lot is the best option for you. Position sizing rules, never risk. Like you have heard about the position sizing rule from so many places, but still, as per the experience, we don't listen anybody. We do what we like. What other teach or what other tells, we don't bother. For example, if like there is a it's not a rule, it's not a law, or it's not a something that everybody should follow. But if somebody is telling us based on their experience, so that means we can learn from their experience rather than making a mistake and then blowing the account. So never risk more than 1 to 2% means what people do, they have the account for 50,000 and then they just go for the standard lot. So when they go for the standard lot, let's say their account is for 50,000. If they're using the pro forma, or if they are using their own money with 10,000 or $20,000, and then they go with the standard lot, and they're going to blow the account. Not today, maybe tomorrow. So calculate your lot size based on your stop loss distance and risk tolerance. Next is the leverage and margin. Leverage, if you don't know, I'm talking about the leverage. If you are a new trader, and you don't know what is the leverage, leverage is the biggest problem. So many trader, they don't have money. Actually, not trader, we can call it learner. They don't have money, but on the internet or on the social media, there are so many so-called traders who tells like if you have $100, you can make $1,000, you can make $10,000, or you can make $50,000. Why they say that? Because the more leverage you get, the more chances you have to lose your account. Nobody is going to make millionaire, or nobody is going to make thousands from $10 balance or from $100 balance. Because this is what I'm listening from the social media or from the so-called social media traders. Like if you have $100 in your account, you can make 10,000 out of it. Practically, it's not possible. Yes, if you don't trade, if you gamble, yeah, there is a chance that you can make 10,000 or 1,000 or maybe 50,000 with $100 balance. So when you leverage, so that means you are borrowing the money from your broker. You have 1,000 account balance, that is your personal balance, and the broker is giving you 50,000 balance or 100,000 balance. Whatever the broker is giving you, that proportion goes to the leverage. For example, 1 by 100 leverage means you have 1,000 and the broker is giving you the remaining money to control 100,000 position. So margin is the deposit required to open and maintain a leveraged position. It's not a fee, it's a collateral held by the broker. So that means when you open a position, they hold some amount of your balance as a margin that will be yours. So margin call, a warning from your broker when your account equity drops below the required margin level. If you don't add funds or close positions, the broker may liquidate your trades. So always before you open a position, check how much leverage you are getting from your broker, how much balance you have, how much bigger lot are you going to open. Are you going for standard lot, are you going for micro, or are you going for mini lot? And then how much margin you have. If you have less margin and you take the bigger lot, then if your stop loss is far but your margin call is close, then the broker will close and your account will get liquidated. Double-edged sword, that's called like leverage amplifies both profits and loss. A 1% move against you at 100 leverage wipes out your entire margin. Beginners or new traders or the learners should use low leverage. That's best for you while you are in the learning phase. get 1 to 10 or 1 to 20 leverage. And then free margin is the amount available in your account to open new trades. Free margin is, it's very simple calculation. Free margin is equal to equity minus used margin. Let's say if you already open a trade, and then you have to see the difference, how much is the balance you have. Then they tells you like this is the margin that you have. So the next trade you open carefully. So you have to keep a healthy buffer between your balance and the margin. So when you open an account, you know what is your leverage, you know how much balance you are going to get from your broker. Then the next comes the types of order. There are different types of order like market order, limit order, stop loss, take profit, and trailing stop. What is market order? Market order is like whatever the price at the moment when you press buy or sell button, the current market price. Execute immediately. Use when you want to enter or exit a trade right now. So if the current market price of BTC is 79,800 and you are going to buy, so it will trigger at the current price plus the spread that a broker keep. Limit order. Basically, what is the limit order? You are expecting tomorrow market is going to drop to 78,000 level, and you will put a limit order like when the market retraces back and comes to this level, they will pick your order. That is called a limit order. That is basically a specific amount that you can put in, and then you can say, okay, this is the price that I am expecting, and then once the price comes here, then I will buy or sell from that price. So you have to put a limit order. If you execute immediately, that will not be a limit order, that will be a market order. So what is a stop order? It triggers a market order when price reaches your level. Buy stop is equal to above current price for breakouts. Sell stop below current price. So what is the stop loss? Everybody knows. If you basically it's we call it a stop loss. So basically it's a stopping loss. It's not a stop loss. I would call it a stopping loss. That means because mostly new traders they go for leverage, and when they open a position, if they don't set the stopping loss, what happens? If they don't set stopping loss or stop loss, what happens? Price go against and their account will get liquidated. For example, you open a buy position at BTC at the price of 78,000 and you expect that it will go to 79,000, but instead of going to 79,000 it drops to 78,000, but you did not place your stop loss. So maybe it will fall more beyond 78,000, it goes 77,000. Now it depends how much balance you have, how much leverage did you get. It depends. So stopping loss means how much loss you can bear. In short, stop loss word it makes a trader scary, especially the new trader. If you know the market, if you understand the market, then nothing makes you scared. Of course, scary, greed, fear, and greed is a part of trading, but stop loss basically is a stopping loss. You have to stop the loss, how much loss you can bear. Take profit. Take profit is the opposite side of stop loss. Like if you are expecting the market will go to 80,000 for the BTC, you open a position at 79,000 and you will set your profit. Okay, when the price go to 79,000, it will trigger your take profit and you get 1,000 profit. Trailing stop. Basically, trailing stop is something that until the price moves in your favor, the stop loss will be a dynamic. It will move with the price. For example, you are expecting the BTC will go to 85,000. So how the stop loss will work? And you open a position at 78,000 and you are expecting the market will go 85,000. So when the price keep going from 78 to 79 and then 79 to 80, the stop loss will move with the price. You have to set how many points the market should be away from your stop loss. You have to enter that value and then it will keep trailing until your target hit. So in case, why actually trailing stop is better? It gives you more options to get more profit. It keeps chasing the price until price goes in your favor. Have you ever thought why a common man, when I say common man means a retail trader, why a retail trader or why a common man have access to the trading market? Because retail trader, they are the bait of the institutions. For example, we can say it we like a retail trader is a liquidity. And what is a liquidity? Liquidity is something like when you open an order, for example euro USD, you send an order, buy an order on the market price, not the limit order, at the price. Let's say you open an order for euro USD at $100. You close the position. When you close the position, that means you bought something and now you are selling it. When you sell it for $110, you make a profit for $10. When you sell it to somebody, right? And then your sell becomes a bias for someone. It's just like if you go buy something from a superstore, they buy from another store or from the wholesale or from the manufacturer or from a factory. So you buy something and you sell it. When you sell it, that means there was another customer who bought it from you. You sold it at 110, you made a profit for $10. Somebody bought it at 110. So now that is an order. Now he will look for the price that is favorable to him. How? He bought it at 110. He will not sell it at $100. But if he sees like, okay, market is not in his favor and he sell it at $100 or $90, so that means he's made a loss for 10 or $20. So this is how market move. Somebody is buying, somebody is selling. Who is selling? That sell becomes a buy for someone and the buy is becomes sell for someone. So this is the liquidity. Join our Discord community for more trading education, market discussions, and learning resources. Scan the QR code on screen to join. And one last important information. This content is provided for educational and informational purposes only and should not be considered financial investment or trading advice. Trading financial market involves significant risk and losses can exceed deposits. All trading decisions are made at your own risk. We do not guarantee profits, income, or specific results. Past performance does not guarantee future outcomes. By using this content, you acknowledge full responsibility for your own trading and financial decisions.